When I first started investing, I had this exact same question. I knew that I wanted to invest, but I was feeling really nervous about how high the markets were, and I wasn't really sure if it was best for me to go all in and invest all my money right now, or whether it was best for me to phase my money in over time. But this is a question that we all ask ourselves at times, especially when the markets are looking high as they are right now. So what should you do? Should you go all in, or should you phase your money in over time? Well, let's not beat around the bush here. Statistically, you are likely to get a better return if you invest all of your money straight away. That's it. Simple fact. But let's be honest, that's quite clear to see. We all know that the stock market goes up more than it goes down. So by that logic, the longer that you're invested, the more chance you've got of capturing those returns. But is this always true, especially when valuations are really high as they are right now? And if it is true, then why am I recommending that most of my clients do not do this and instead phase their money into the markets over time? Well, in this video, we're going to dive into the data and we're going to find out. Hello and welcome back to the channel. For anyone that's new here, hi, my name is James, and this is the place where you can learn everything that you need to know to make better financial decisions. Before we dive into the data, let's just start off with a couple of definitions to make sure we're all on the same page. What do I mean by lump sum investing? Well, this is pretty straightforward. As soon as you decide you want to invest, you invest all of your money at once, no questions asked. Whilst phasing your money into the markets, also known as dollar cost averaging, is where you hold back the majority of your money and instead systematically invest it over time, typically over a number of months or years. Now, the headline answer to this question is simple. If we think that the stock market is going to go up over time, which we do, otherwise we wouldn't be investing in the first place, then it makes sense that the earlier that we can start investing, the higher chance we have of capturing those returns. However, if the market were to fall in the short term, phasing our money into the markets would be advantageous because we would get this dollar cost averaging effect whereby each month we're getting to buy in at a lower and lower price. So the obvious question is, how likely is this to happen? How likely is the market to fall? Now, the best way that we can work this out and get a good idea of what might happen in the future is by looking at what's happened in the past. So let's just take a look at some data. Here we're comparing the performance of a lump sum investment versus a 24-month dollar cost averaging strategy. So that's where we're investing the same amount, but we're just phasing it into the market slowly over a 24-month period. And here we're looking back at every possible month that you could have chosen to start investing in the S&P 500 between 1960 and 2018, so that we can see which strategy would have outperformed. So to create this line, we've taken the performance of DCA or dollar cost averaging and then subtracted the performance of lump sum investing to leave the difference between the two. So if we are below the line and it's negative, like it is here, minus 25, it means that lump sum investing outperformed dollar cost averaging by 25% over the following 24-month period. But if it's above the line and positive 25%, it means that dollar cost averaging outperformed lump sum investing by 25%. And as you can see, there are very few periods where DCA outperforms. And the only time it does outperform is during big market crashes, but obviously they don't happen that often. So if you were to pick any random month to start investing between 1960 and 2018, you had a 74.2% chance of getting a better return if you invested all of your money straight away as a lump sum. And not only is lump sum investing likely to outperform dollar cost averaging, but it's likely to outperform significantly. As an average, lump sum investing outperformed by 7.5%. But here we're only looking at the S&P 500. Would we also expect to see the same effects in other markets and other asset classes? Well, if we think back to the basics, any asset that we invest in, because we think it's going to go up in value over time, and obviously that's the only reason why we would invest in anything, should, from a probability perspective, reap a better return the longer that we are invested. And as you can see here, that is true. And at the bottom of this table here, we've got the data that we were just looking at, where you can see lump sum investing outperforms 74% of the time, and as an average, it outperforms by 7%. We've got the S&P 500 over a shorter time period. This is just over 20 years. It has outperformed even more, 78%, and for an average of 9%. And as you can see, the same thing is happening in other markets where we've got emerging market equities, 11% outperformance on average, international equities, and in other asset classes too, we've got gold, 9% outperformance for lump sum investing, bonds, this is just a bond index, 4% outperformance, and just for the last, Bitcoin, 471%. Where it's clear to see that the greater the expected return of the asset or the market, or as we're looking backwards here, it's more the greater the past performance, the more lump sum investing outperforms. I'm sure that this all makes sense to you in theory, but I know it's very hard to put your faith behind this data when we're talking about your life savings, especially when stock market valuations are so stretched as they are at the moment. And by stretched, I mean that the prices of companies in the S&P 500 are very high in comparison with the actual earnings that they are making. The ratio of a company's stock price relative to its earnings is known as its price earnings ratio, or PE ratio for short. So as an example, a company that has a stock price that is 20 times its earnings would have a PE ratio of 20. And to help us see how PE ratios have changed over time, we use the Shackell PE ratio. And here we're looking at how that ratio has changed over the last 100 years. Now, as you can see, there has only been one other time where the PE ratio has been this high, and that was just before the dot-com crash in 2000. Now, whether this is actually a big warning sign or not is a totally different topic for a totally different video. But what you're probably thinking is that when the markets start to get this high, dollar cost averaging over a 24-month period is probably a sensible idea. Well, almost. If we again look back at what has happened over the last 20 years, but instead we group all of the different possible months that we could have chosen to start investing over the last 20 years into the PE ratio at that time, we can see that as PE ratios rise, the benefits of lump sum investing diminish. So at the bottom here, you can see CAPE, which stands for cyclically adjusted price earnings ratio, is just another word for the Shackell PE ratio. So when the PE ratio is above 25, you can see that on average, lump sum investing outperforms by 5%. Now, that increases as the PE ratio gets lower, but the important thing here is that above 25, you're still outperforming with a lump sum investment. Although the one thing to note here is that as the PE ratio gets higher, so in the 30s where we are now, our sample size gets quite small in the fact that we just do not have that many examples in history where we can compare this to. However, the data that we do have still points to the fact that lump sum investing is the better option. So as we've seen, lump sum investing has been the better option even when valuations are looking really high. But why then is it that when a client comes to me with a lump sum of money that they want to invest, that I generally advise that they do the exact opposite? Well, think back to when you first started investing, or perhaps the last time you invested a significant lump sum. Think how closely you watched the markets for the following weeks and months, and how you felt every single drop. And with every single dip in the market, you began to question yourself and doubt the decisions that you'd made. Investing a big lump sum of money is an extremely emotionally stressful thing to do. And the big risk is that it all becomes too much and that you sell out. And trust me, if you sell out, you are not coming back for a long time and perhaps ever. And what you find is that people are often comfortable giving up some returns and phasing their money into the markets so that they can actually just alleviate some of that stress and also give themselves some downside protection. In that if you do invest and suddenly the markets fall, that's actually a good thing, because next month you can go in and invest at a lower price and benefit from dollar cost averaging. On the other hand, if the markets do go up, then, well, that's a nice surprise too. And this is a really interesting point. Striving to get the best return is not always the right answer, especially if it means that you're going to have to put yourself through a lot of stress to get it. So typically I would recommend that clients phase money into the market over 6 months to a year. However, this is not always the case. This is not set in stone. It's very much a discussion that I would have with them, whereby I would show them everything that I have shown you today. And if after that they are still comfortable investing as a lump sum, and I am confident that they understand the risks involved, then there's no reason why we wouldn't use a lump sum. And just to be clear, we would only ever be having this conversation if this money was not previously invested elsewhere. So if this was cash that you decided you wanted to invest, or maybe this was an inheritance you wanted to receive, then we would have that discussion about whether it's right to phase it into the markets. Whereas, let's say you had decided to change your pension provider or an investment manager, and through the course of that, you had to sell investments, transfer them across as cash. It's best to then get that money back into the market as soon as possible and invest on that new strategy as soon as you've decided on that strategy. You do not want to be out of the markets for longer than necessary because, as we all know, stock markets are likely to go up more than they are to go down. So the longer that you're invested, the more likely you are to get returns. So to quickly recap on what we've covered, from a financial perspective, lump sum investing is likely to outperform even if valuations are stretched. However, if you are feeling nervous and you want to take the edge off, then phasing your money into the markets can have advantages and maybe the right thing for you to do. But what I'm really interested to hear is what you think. I want to know what you think, having seen these facts, having seen these figures, having watched this video. Do you think that you would invest a lump sum straight away, do technically the rational thing? Or would you feel more comfortable phasing money into the markets? And also, I'm interested to hear whether your opinions on that might change if different things happen in the market. So please do let me know down in the comments and any other questions that you have about this video. And as an end note, I'd like to say that all the data that I've used in this video has come from Nick Majuli's blog of Dollars and Data, which is a really great place if you are really interested in investing, which I imagine you are if you've got to the end of this video, and you're looking for some thought-provoking content that is backed up by data. If you're into that kind of thing, go check it out.